direct-to-consumer business
Mm-hmm.
through your own channel on Instagram. Maybe you're on Amazon already, but your supply chain, especially early on, if you're doing it right, is probably largely outsourced to a contract manufacturer. And in the early stage, you're going to basically be this much of their book of business. And so, how do you ensure that they're doing all of the things right
Yeah,
and that
yeah.
doing it in a way that you have a clear path to scale? So, I think those are the mistakes that are most common. And so much of what people need for their pets is, again, it's companionship.
Okay.
It's eating, it's getting outside, it's connecting with people, it's
Mm-hmm.
community. It's not tech. Listen to somebody like Elon Musk talk about entrepreneurship. He talks about it as staring into the abyss and eating glass. And you have to have this really high pain threshold that you can
Yeah.
tolerate. It's not for everybody.
Hey guys, before I start the podcast, a quick introduction. My name is Warnith and I'm the founder of Pet Excel Marketing. Pet Excel Marketing is a marketing agency that specifically works with pet businesses. Over the years, we have worked with pet food brand, pet relocation businesses, pet SaaS companies, pet clothing brand, cat food businesses, dog grooming services, and many other product and service-based pet businesses globally. Our services includes everything from creating graphics to running your ad campaign. Not only that, we have built amazing websites and apps for pet businesses. So if you have a pet business and would like us to help grow it, click on the first link in the description to book a call with our team. Now enjoy the podcast. Hey guys, welcome back to another episode of Pet Brand Podcast, the show where we dive deep into the world of pet care innovation, entrepreneurship, and the brilliant mind shaping the future of the booming industry. Today, we are joined by someone who truly needs no introduction in the pet world, Charles Tapp, the visionary founder and managing partner of Vetted Capital. With a career spanning biotech, philanthropy, and corporate transformation, including a pivotal roles in reshaping Mars into a pet care powerhouse, Charles brings a unique and powerful lens to investing in pet brands. At Vetted, he leads a one-of-a-kind team of veterinarians, scientists, operators, and investors, all focused on transforming the future of pet health and wellness. I'm your host, Warnith, and whether you are a founder building the next big pet brand, an investor curious about this resilient sector, or just a pet lover intrigued by the business of it all, this episode is packed with insight you don't want to miss. So let's dive right in. Charles, first of all, thank you so much for being a part of Pet Brand Podcast.
Of course, thanks for having me. You're far too kind. I appreciate the chance to share with your audience, and look forward to the discussion.
Yeah, love it, love it. So yeah, let's start from the beginning. Listener would love to understand the why behind a founder's journey, right? So like, take us back to your journey, like what inspired you to launch Vetted Capital and focus on the pet care sector.
Yeah, so I've split my career between the Cokes and Mars. Mars is most relevant for this conversation. I was lucky to be in the right place at the right time at Mars and learn about the pet sector. The longer I've known about it, the more fond of it I've gotten. I've owned several dogs myself. I've always been a dog lover. Had a couple Labradors that we lost to hemangiosarcoma on the same day as diagnosis, one at age 7, one at age 9. And so there's always sort of been this impact focus as well. But during my time at Mars, I saw this increasingly sort of growing scale and the inability for internal organic growth to keep up with the sort of growth expectations that we had for the company. And I think as all of the companies in the sector, Nestle, Mars, Colgate, or you name it, grow, they increasingly need more growth stage assets to develop, and growing at the sort of pace that they need to grow for their investors' expectations. So, we launched Vetted based on a problem we saw from both sides of the table as founders, realizing that there wasn't enough specialist capital focused on this sector. And then I think, from the LP, from the strategic side, wanting more exposure to assets that were more mature that would allow them to focus on later stage growth ambition. And I'll talk more about that. In short, that's the gap in the market that we saw. There was one other specialist fund in the sector, the companion fund, the Digitalis Ventures runs for Mars that we helped set up while I was there, and Jeff and Ben and Cindy, they're a great team over there, but it's basically 100% Mars backed, and we thought there might be an opportunity for other investors to have the same exposure to early stage growth assets. So in short, that's why we put the fund together.
Yeah. And currently, how many members do you have in your team, and like, what are their backgrounds?
Yeah, great question. So we have around 12 members that include sort of scientific advisors, et cetera. There are three general partners on the team. So it's a fairly lean team. It's
mm,
meant to
mm,
be largely kind of virtual, very specialist, allowing us to invest across all the different subsectors within the pet sector. And
mm, mm,
but yeah, we have a number of veterinarians on the team. My
mm,
co-founder, Aaron Wallace, is a veterinarian, and David Howarth, who is an early team member, is also a veterinarian and a PhD. We have several on the team.
mm,
We also have more consumer investors like Brock Weatherup, who has sold companies to Petco, PetSmart, has more of an
mm,
e-commerce
mm.
background. So fairly diverse specialist expertise. I've always believed that there's value in generalist expertise, but a lot of the value, especially for founders, is having people that have been there in the trenches, built companies like this, and can talk
Yeah, yeah,
about
definitely. Yeah.
it's like.
Definitely. And since you have a remarkable diverse background, like spanning biotech, innovation, high impact philanthropy, and large scale corporation transformation, right? So, how did those experience like shape your approach as an investor when you are going to market?
Thanks. Yeah, I mean, fundamentally, I think these different types of experience really help you make connections across the different verticals, and it's the pattern recognition that comes from that that makes you a better generalist investor, and you can distill the essentials.
Mm,
Seeing those commonalities and also the important differences, I think, can really help you understand the essentials of being a good investor. I'd say biotech, it really reminded me of the importance of specialist expertise, of discounting, and really doing the expected value calculations and being able to adjust for company maturity based on stage and all the big technical hurdles to come, whether they were scientific and clinical
mm,
or
mm,
regulatory, right? I think on the philanthropy side, it taught me that with patient capital and persistence, you really can change the world, believe it or not. It takes a
yeah.
lot longer to think, but you can. I think corporate innovation really taught me the importance of having a clear stage preference
Mm,
based on a clear growth target and knowing what's big enough for you to spend your time on, because so
mm,
many people get distracted with early stage
yeah.
technology
Mm,
and miss the big picture.
mm,
I think one of the things that Mars has done well is they continue to
mm,
have the end in mind and then reverse engineer a portfolio of solutions that can help live up to that kind of growth ambition.
mm,
And I think we've taken that insight here at Vetted and tried to start with the end in mind, have a portfolio that we construct that we believe will bring alpha diversification to investors while bringing specialist expertise to the founders who need
mm,
help
mm,
reaching stage of growth on their mission to help change the world.
mm, mm. Zooming out a little bit, like, if somebody's listening to this podcast and they are not from the pet industry, but they want to get inside the pet industry, the pet care category is clearly booming. But, like, if you have to explain that, like, what's really behind this search, like, from your perspective, what major societal or market trends are driving the explosive growth in the pet care industry?
Yeah, great question. I think most directly it's sort of pets becoming family or this notion of pet humanization
Yeah.
and growing pet ownership globally,
Mm,
right?
mm, mm.
I think it's slowed a bit post-pandemic. In some ways, the growth rates have slowed in part
Definitely.
because
Yeah.
pricing has been aggressive and
Mm,
inflation eventually takes its toll. But
yeah. Yeah.
at the end of the day, I think those are pretty enduring trends. And I think the underlying trends that are less obvious but really important are these really secular societal trends of declining marriage formation, declining birth rates, rising
Mm, mm,
loneliness associated with what Peter Thiel has called falling into our phones, right?
mm,
In effect, social media disintermediating real community. And I think
mm.
that's had an impact on people's desire for, pets
Human
as
Yeah. Mm.
ways that they compensate for that. And so tech trends come and go, but I think humans always need companionship. That won't change. And I think pets are one of the most pure play ways to access that trend in the
Mm,
world.
mm, mm. A lot of podcast guests that come on our podcast, like, they talk about that this industry is recession proof. Like, it's their perspective. They say that it is recession proof. Like, what's your perception on that?
There's no such thing as recession proof. I
Yeah.
think there's relatively resilient and
Mm,
defensive sectors. And I
mm,
think food is one of those that has proven to be that way. I think if you look at vet clinics right now,
mm,
you're seeing in some ways some slowing based on years of price hikes that are eventually catching up with them. And at the same
mm,
time, even if visits are down, with prices still going
mm.
up, but I think you see revenue is not really taking a big dip. And so
Okay.
while it's a tough
Mm,
market, I don't want to undersell that. I think it's
mm,
also to remember that many of the pets that were adopted during the pandemic are at
Mm,
midlife stage where their healthcare expenditure will probably be the lowest that it would be at any point in their life. Early
mm,
stage pets have vaccines and other things that you do when you first adopt the pet. Late stage, obviously, there's a lot of care coming, and so we
mm,
we tend to think we're sort of at this unique place in the middle of life where it may seem relatively tough right now, but
mm.
we're not traders. We're not looking for a momentary opportunity to make a buck. This is a long-term,
Long-term
multi-generation
game.
trend, and over the long term, we think it will continue to be a remarkably resilient and defensive sector that
Mm,
performs well, rain or shine, so to speak.
mhm. And you have said that, before that pets are more than companions, like they're health catalysts. So how do you see pets shaping not just the consumer market, but the healthcare and even like human longevity?
Yeah, I mean, the science is clear, and Mars has funded a lot of this, but others have as well. I mean, pets get you outside when you walk them. They bring you community when you go and
Yeah.
run into people at the dog park. They
Mm,
reduce
mm,
cortisol levels and stress. They improve your cardiovascular health from the exercise. And they even, ultimately, I think that accumulates into extending your own lifespan, right? So for the wonks among us, there's lots of stuff on translational medicine and starting in pets and converting that into humans, things like
yeah.
longevity, One Health. Look at Loyal as sort of the flag bearer for this right now. But we think in general that's a real trend, and whether it's things like oncology or other aspects of aging, there
Mm,
is a real opportunity to um, develop insights and technology for pets that has a real impact in the human space, and we're excited about that opportunity and be able to back companies like that.
mhm. Yeah. And like despite the tailwinds, like many investors still hesitate to go all in on pet care. Like what do you think, like what misconceptions do investors or founders often have about the pet care industry?
Yeah, I mean, there are a ton of them. And I did a LinkedIn post on this on the farmer's dog that you could go and look at too. But I think
Mm,
some would say consumer VC is dead in general. Like they would say, didn't, CAC go up after Apple instituted all the privacy changes? And, isn't this a lot less profitable than it used to be? Some just would, you go to Silicon Valley and you walk around on Sand Hill Road, and some would just say, isn't that silly? If you talk to, Greg and Aaron about starting Rover, I think when they first did it, everybody was like, you're going to do what with your career? Like, why would you do something like that? Right.
mm, mm, mm,
Blackstone, $2.3 billion exit later. We know
mm.
who was right. Um, uh, some think the sector is not big enough. Like, why would you do that? Is this the kind of thing that can deliver venture scale outcomes?
Yeah,
Most
yeah.
VCs would say, if you can't get $1 billion exit here, then why would you even focus on it? And
Mm,
yet, I think if you look back at the history of exits here, there are a lot, whether it's Blue Buffalo or Rover that
mm,
we just talked about, that are well in excess of $1 billion. And so,
mm.
at the end of the day, the critics don't bother us. We're clear, we're focused, we have conviction. It's not for everybody, and we're not looking for additional competition anyway. So.
Yeah, definitely. And Vetted Capital calls itself a rare breed, like, and your team like truly reflects that. Since I've already talked about, you assembled a rare breed of veterinarians, scientists, operators, and investors. So how does that multidisciplinary team create an edge when it comes to like investing?
It's a great question. I mean, so much of investing, we think, is not just picking the right companies, but helping them
Mm,
once we've made the investment. And I think we're not
mm,
tourists. We've been here, we've seen or been part of many of the deals that have happened in this space over the past 20 years. And so the vets, they challenge assumptions and diligence. I mean, our vets would not allow us to invest in a food company that they thought had quality and food safety risks, as an example, which is just one of the
exactly.
biggest
Mm,
risks that any
mm,
brand deals with, right? And so it's great to
mm,
have that kind of check in place on the deals where you might look at one and say, look, I mean, they're crushing it. They grew 300% last year, and it feels like they're going to reach escape velocity. And the vets would say, I
mm,
don't care. At the end of the day, if there's quality and food safety incident, that's a
mm.
brand killer. Our investment's going to be done.
Yeah.
Scientists help us see around corners and see what's coming. I think
Mm,
generalists like we say, but yeah, but that's great. But let's talk to them in 2 years. That's just too early for us. And the
mm,
opportunity cost of spending our time on something that's too small is just too
mm,
too low for us right now. So
mm,
I think it's the diverse perspectives, the intellectual diversity that comes from scientists and clinicians who are literally still spending weekend shifts in the clinic sometimes and know where the gaps are for certain types of therapeutics that are missing or where something's not good enough yet.
Mm-hmm.
It's all of that. When you bring that together, it really is more than the sum of its parts. And ultimately, we think the crosstalk helps us back the companies and then help them succeed once we do.
Yeah, yeah. Wetted's investment sweet spot is between $2 million to between like $20 million, like a critical growth phase for many founders. What stage is just right for a brand to approach you?
It really depends on the vertical. I would say it varies quite a bit, but generally, I'd say for consumer companies, we'll focus a little bit later. So sort of Series B, C, occasionally a
Mm,
little bit later than that. Typically, we'd want to see a company that's 10 million plus in run rate for a food company. So
okay.
fairly late, the brand is already clear. There's clear
Mm,
product market fit.
mm,
I think we were willing to go a little bit earlier on healthcare, especially like pharma diagnostics,
mm,
as well as deals. The exits in those verticals have clustered smaller, and so you have to have a bit
mm,
of an earlier entry point to get the same kind of return profile. Whereas I think in consumer pet food, especially, you've seen some of the large exits that we've talked about. You can have a later entry point.
mm,
Ultimately, we see things that are growing at, in venture and growth equity, you typically want to see 50 to 100%, if not more, year-over-year growth rates. And so I think things on the earlier side of the continuum will want to see higher growth rates, probably 100 plus.
mm.
Things that are later and maybe are 50 million plus in revenue already, if they're growing at 50% a year, like that's still pretty
Okay.
reasonable for us.
Mm,
Generally, it's my view that in consumer, you want to see a company reach for a pet food company. It probably these days needs to reach 200 million in sales to exit. And so within the life of our fund, we need to be able
mm.
to extrapolate how many years is it going to take for them to reach a
Wow.
threshold like that, and
Mm,
are they on that kind of trajectory within the life cycle of our fund or not?
mm,
So
mm,
that, whereas I think on pharma, it's different. Often there's a lot of clinical development that needs to take place, sometimes
mm,
across multiple indications. Sometimes you'll need to fund multiple pivotal studies to reach
mm,
X scale that a Zoetis or a Behringer or a Elanco would be comfortable taking an asset in. And so
mm,
it really does depend on the vertical. But generally, somewhere in that Series A, Series C range is our sweet spot from an entry point perspective.
mm. Love it, love it. And you worked closely with countless founders, some successful and some like still learning, right? So, what are the common traits or mindset you have seen in the most successful pet brand founders?
Yeah, we're really lucky that we do get to see a lot of deals. I mean, I wouldn't claim that I've worked with, more than a lot of people, but we do get to see a lot. We probably
Mm,
at most of the deals in the sector. And I think a lot of this is just pattern recognition and you start to see these same kinds of trends. But,
yeah.
I've looked a fair amount at the sort of scientific literature on this topic, and then it's funny to see this play out in real life. They're gritty, they're intellectually curious, they're really
Mm,
ambitious, but they're also unflappable. I think if you listen to somebody like Elon Musk talk about entrepreneurship, he talks about it as staring into the abyss and eating
mm.
glass. And you have to have this really high pain threshold that you can
Yeah,
tolerate. Not for everybody. 99% of
definitely.
these fail. It's really, really hard. And I
Mm,
think the kind of people that can tolerate that persistently for,
mm.
by the time they get to our desk, it's usually they've been working on this for 6 to 8 years of their life already. They've been through multiple of these cycles where the company, the status quo and the base case is this company will die. And so if you've survived that death 3 or 4 times already in terms of the number of financings, and you can tolerate that and you're
Mm,
just sort of even keel and like the hard thing about hard things, to use, Ben Horowitz's language, like if you've been through that cycle and you can
mm,
do that, you have a clear, no nonsense plan about what you need, what it's going to help you deliver, where the investment's going to take you, and why us. I think those are the kinds of people we want to talk to, right? So some of it's sort of character and
mm.
personality traits that are ingrained. Some of it's learned, I think, through the cycle of being a founder and just dealing with a bunch of really hard stuff.
Yeah, yeah.
And then some of it's just having a pretty clear sense of where you want to go and how we're going to
Mm.
be able to. But I think those are the kinds of founders we want to talk to.
Yeah, yeah. And on the flip side, like mistakes are inevitable, but avoidable one can be costly. So, like, what do you believe are the like top mistakes pet entrepreneurs make, like, and how can they avoid them?
Yeah, I mean, there are a lot of them and they vary by category. I think in pet food,
Mm.
we already talked about quality and food safety, which is really hard
Okay.
because in
Okay.
the early days, you're probably building a direct consumer business
Mm.
through your own channel on Instagram. Maybe you're on Amazon already, but your supply chain, especially early on, if you're doing it right, is probably largely outsourced to a contract manufacturer.
Mm.
And in the early stage, you're going to basically be this much of their book of business. And so, how do you ensure that they're doing all of the things right
Yeah.
and that
Yeah.
doing it in a way that you have a clear path to scale? So, I think those are the mistakes that are most common on vet med. It's quality of care. You just can't cut corners on that front at all. Reputation is everything, right? And so we take that very seriously. I think in areas like pharmacy, it's regulatory compliance, right? And making sure that you're not, having pills being sent for uses that they shouldn't be, right? Those kinds of things. And so it really does vary by category, but I'd say a general overarching
Mm.
observation is just managing expectations is really hard. On the one hand, you're always fundraising, you're having to
Mm.
tell all these people that you're going to conquer the world. And
Mm.
at the end of the day, you have to deliver those expectations, whatever you sell. And so
Definitely. Mm.
I've always ascribed to the sort of simple shorthand that happiness equals reality minus expectations. And so having as conservative of expectations as you
Yeah.
can is good. And I think the counsel of, believing that company building usually takes twice as long and is half as rewarding as you think it's going to be is a good sort of baseline instinct. And so asking yourself before you even get on the path,
Yeah.
if this was twice as hard and
Mm.
half as valuable as I thought it was going to be, would I still do this?
Mm.
Because frankly, I mean, like the number of decks that we get from companies
Yeah.
that have stalled out in the 500,000 to 2 million run rate range for years at a time and just continually try to go out and raise the next
Mm.
$500,000 to keep limping along.
Mm.
There's a lot of them that, I mean, frankly, that's the norm. And I
Mm.
think for those founders, we try to be very honest with them and just say, like, do you really want to go ask your friends and family for that next $500,000 to keep doing what you're doing right now?
Mm.
And
Mm.
I think really hard about the opportunity cost of your time staying with this venture
Mm.
that
They do.
seems stalled,
Mm.
versus moving on to the next thing. If you really want, venture money and angel money to do it,
Mm.
I it's hard, and we see a lot of people get stuck there. So
Mm.
yeah, I would like those are some observations that being very thoughtful about how you spend your time, being
Yeah.
realistic about your expectations, and
Mm.
then avoiding the catastrophic mistakes that can take businesses out.
Yeah. Yeah. And what would you say? Like, what's the failure percentage?
In general,
Yeah.
across all company formation, I think if you looked at all stages, which it's going to be disproportionately represented by pre-seed and seed,
Mm.
it's well over 30%, right? And as you get down to some of the later kind of growth stages, it's
Mm.
much lower. But yeah, I'd say pre-seed tends to be 90 plus percent,
Mm.
95 plus percent. Seed is still probably 80% failure rates over
Mm.
time.
Mm.
A is probably 60 to 70. By the time you're Series B, it's probably 40. And by the time you're Series C plus, you're
Mm.
probably closer to 20 to 25. But it's hard, right? And the
Mhm.
default should be the expectation that this isn't going to work.
Definitely, definitely. And many early age founders struggles with pivotal questions like should they raise outside capital or keep like bootstrapping. So if a founder is at a crossroad, say between raising or bootstrapping, what mental framework should they use to decide?
Yeah, I mean, bootstrap as long as you can, right? That's not
Okay.
possible for everybody, right? But there's no substitute for equity and ownership. And,
Mm.
Carta's got pretty good data on just how much dilution there is to come across rounds.
Mm.
But there's no substitute for equity. Like most of the time,
Mm.
founders, once they get to exit, they'll be lucky to own 10 to 15% of
Mm.
the company they started by the end of it.
Mm.
Uh, there's just a lot of dilution to come. So I'd say don't kickstart that process too aggressively. Go out, take the minimum viable round that you need if you can't bootstrap it entirely yourself. Don't try to go out, and I've done this. Don't try to go out and raise a $10 million Series A. When you really haven't hit seed milestones yet. It's overly dilutive to shareholders. It reflects excessive risk
Mm.
aversion. Instead, go out and raise the 500,000 to 750,000 pre-seed round. Go get some data, prove that this is a product that people actually want or service people actually want. In that case, you're going to sell maybe 5 to 10% of the company as opposed to selling 30% of the company out of the gate, right? It's a huge difference between those two things. And so I think being willing to go take less money,
Mm.
prove it, bet on
Proof of
yourself,
concept.
spend the
Yeah.
time back with leverage, and then have investors competing to get into your round is a very different posture than going out with nothing and asking for $10 million.
Mhm. Since growth is the name of the game, but the best channels differ by brand type. So in the brands you have backed or studied, like what growth channels have shown the highest ROI? Is it retail? Is it D2C? It's subscription or like wet led?
It really depends on stage and it depends upon the product that,
Mm,
and the channel that's appropriate for that product. But I think some of the best founders we see are ones that are going out D2C,
mm,
refining,
okay.
confirming product market fit, doing it there. I
Mm,
mean, Amazon is a huge channel, right? Chewy's a big channel too. I mean, those are big channels with a lot of customers, but until you're ready for it, it usually is best to start D2C with a consumer product,
mm,
whether that's a supplements business, a food business, whatever it is. And then I think as you reach scale, retail can make sense, but you shouldn't be naive about trade spend and all of the capital and the expertise that's going to be required to enter retail effectively. Thinking about the right channel for your brand, whether that's a pet specialty player like a Petco or PetSmart or a Target or a Costco. I mean,
mm.
it does depend upon your product. And so I'd say initially our bias is to stay D2C as long as possible.
Okay.
And do the sort of least different thing along the way. And so maybe go to Amazon next, and then Chewy next, and then out into retail from there. But it really the go to market obviously depends very much on the specific product that we're talking about.
Okay.
The channel I think is really important for establishing brand and trust. There is no substitute for having veterinarian support. And it's funny because it's very different than a lot of the human health channels
Mm, mm,
because we know how a product impacts us when we take it. We feel much more comfortable going online, doing our own research, and then going on Amazon and ordering something for ourselves.
mm,
Whereas at the end
mm.
of the day, we don't feel like we really understand what's best for our pets.
Yeah,
And
yeah.
so I think the vet channel has been much slower to evolve in that direction. It's
Mm,
happening,
mm,
right? I think you are starting to see sales migrate out of the vet channel onto Chewy, for instance, but it's been a
mm,
much slower process, and we still think the vet channel is important. It's also slow. Vets are very conservative, and
mm,
if it's
mm,
not broken, they don't fix it. And so, as a really fast-paced go-to-market strategy, it's usually not the case that starting in the vet channel expecting this hyper growth that is realistic, right? I still think D2C tends to grow much faster as you would expect it would.
mm. Love it, love it. And what do you think? Like, what does it take to be acquired by or compete with like giants like Mars, Petco, or Zoetis?
Yeah, I think we talked already about pet food
Mm,
brands and really needing to probably get to 200 million in sales. I think it needs
okay.
to be big enough to be meaningful to them,
Mm,
where it's worth their time to take something that has reached a scale where they can then add their distribution, whether
mm,
that's taking it from a national brand into an
mm,
international brand, or if it's a pharma company, you've proven with one asset of the platform that it works for this indication. You have done all of the preliminary work. You've done the pivotal trial. You're not going to take that to market yourself. Zoetis, Elanco, BI, Merck, they have, world-class commercial teams, Siva, that they're going to take the products to market with, right?
mm,
You can prove that this is an entirely new platform, a new modality perhaps that they haven't used before. You've proven the unit economics, you've proven the manufacturing capacity, you've proven
mm,
the efficacy, safety, and trials. I think in those cases, they can be very interested because they can say, okay, I can take this and tailor this to osteoarthritis and atopic dermatitis and all of the big chronic indications in
mm.
animal health. And those are the things that would get them excited. But it really does depend on the specific vertical. But I'd say the essentials are it needs to be built the right way, so there's not going to be a whole lot of rework.
Okay.
It needs to
Mm,
be big enough in terms of scale to make it worth their time.
Mm.
And typically, it needs to bring something that's outside their existing capability set. So, trying to go to a pharma company with another small molecule parasiticide product, maybe you'll be able to compete with their internal capabilities, but you probably won't. It typically is focusing outside of their sweet spot in a
Mm.
place more of an adjacency for them from a capability perspective and maybe even a business model perspective.
Mm.
And I
Mm.
think those are the areas where companies typically acquire as opposed to try to build themselves.
Mm. No, but let's shift gear to the future. Like tech is changing everything, and pet care is no exception. So, where do you think AI, data science, and biotech will most impact pet care in the, let's say, in the next 5 to 10 years?
Yeah, great question. Most people would say diagnostics and personalized health recommendations, early disease prediction, and I
Mm.
think some of that's already here and it's happening. I
Mm.
don't think it's as transformative as most people believe it could be. I would say AI is actually going to create the most value for um, unsexy, relatively routine, but low margin businesses right now. So if you think
Okay.
about insurance,
Mm.
pharmacy, distribution. If you think
Mm.
about areas where these very historically low EBITDA margin, but relatively repetitive tasks
Okay.
that some have historically been solved with
Mm.
software, but
Mm.
if you think about the opportunities there for AI agents to come in and automate wide swaths of customer care, of
Mm.
claims processing, of underwriting, of routing, those things can take what has historically been, let's call it a 3 to 5% EBITDA margin
Mm.
business,
Mm.
at a 10, 15% EBITDA margin business.
Okay. Mm.
And I think that is really where AI will be the most transformative. And so if you think about the big players that have those kinds of cost structures right now, that they're
Mm.
able to, um, sort of leapfrog with AI and automate a lot of that back end processing, like those are the areas where I think AI is going to be most disruptive and increase profitability the most. And so I think you'll see smart progressive PE
Mm.
firms looking at buyout stage deals, looking for big books of business in those low margin industries, and then just sort of stripping out the cost structure in the same way that historically they would have done with business process outsourcing and farming everything out to India. I think they'll sort of reshore it with AI in a way, right? And I think that's a trade that's already underway, but you'll see a lot more of over the next 5 years.
Love it. Love it. And for newer brands, trying to future proof their business, how should early stage pet brands position themselves to stay ahead of industry disruption?
Yeah, I mean, I think one of the benefits of AI is that it's never been easier to build a new company, right?
Mm.
With
Mm.
people because you have so much more
Mm.
labor, if you will, at your disposal for relatively cheap. And so I think founders can be less diluted than they ever were because you don't need necessarily a five founder business anymore.
Yeah.
It's a lot easier to have a 1 to 2 founder business in
Mm.
most cases. So you can build lean, you can build asset light businesses that are AI native, and
Mm.
that makes quicker starts. It means you need less capital to start the business, and then you're less diluted. And so it's going to be much more rewarding. And so even if you don't build a company that's $1 billion exit, if you build a business that you can sell for $50 million, but you own 80% of it, as opposed to building $1 billion business that you might own 5 to 15% of, it's
Mm.
comparable in terms of the reward structure. So if I were a founder now, I would think about starting as lean as possible. I might be starting multiple businesses at once
Okay.
and see which ones stick,
Mm.
because you can do that and have 2 or 3 that I'm sort of exploring in parallel and then down
Mm.
selecting as I figure which one has traction. And again, keeping as much of it as possible for yourself.
Love it. And despite all the innovation, some white space still remains in the pet care market. What areas of innovation do you believe are like still untapped in the pet space?
It's a good question. I mean, it's not necessarily innovation. I think it's jobs to be done. It's customer problems that people have. Like, what are people still struggling with the most,
Mm.
right? Is it still finding a dog sitter? Because in many cases, those problems just do endure. Like
Yeah. But I guess
find
there is a lot of already like apps and website for that, right?
theoretically, but I mean, in terms of increasing penetration
Mm.
behind those existing big problems, I think there's still a lot of opportunity there where it's not necessarily a new solution. It's really just getting more adoption
Mm.
in what, you know, I mean, if you talk to Aaron and Greg about the rover business they started or listen to some of the interviews they've given, they'll talk about
Mm,
it was really hard to figure out how big the TAM for that was because they were competing with a black market in a way where people were asking their friends to dog sit, right? And so there's no transaction to observe. And accordingly, it's pretty hard to estimate just how big this market could be. And I would say they're probably still in that phase of, they're private now. It's probably, I would guess it's still sub a billion, but probably a few $100 million business based on where it was when it was taken private.
mm, mm,
And I guess is there's still a lot of headspace for a business like that to grow just behind that same use case. So I say all that to say, like, it's not necessarily some great new tech. In fact, it might be, to come back to the earlier conversation we had, it might be taking AI and applying that to the
mm,
marketplace, make it more efficient, profitable, so they can spend more on marketing and grow the user base behind that same job to be done and just increase penetration in a market
mm,
that's not yet sated, right? So I'd say that it's not always about the tech. It's about what people actually need. And so much of what people need for their pets is, again, it's companionship.
okay.
It's eating, it's getting outside, it's connecting with people, it's
Mm, mm,
community. It's not tech, right? And so to the degree that tech enables those things, great, right? But don't get distracted by innovation per se. Think about the
mm,
problem
mm,
you're actually trying to solve. And I'd say there are some pretty big ones, whether it's what we just talked about, whether it's walking, whether it's grooming, whether
mm,
it's um, a better vet experience or something
mm,
like that. It's
mm,
not necessarily something you haven't thought of yet. It's just executing on those existing pain points better.
Basically, improving the things that are already working. Mm.
Um, Sometimes they're working, sometimes they're not working, right? It's
Yeah.
making them function. So yeah.
Yeah, yeah. If you had to place a long bet, like what would it be? If you had to bet on one emerging subsector in a pet care over the, let's say, over the next decade, like what would it be and like why?
Yeah. Um, as we talked about, I think,
Mm,
and Bezos talks a lot about this. You're trying to figure out where to place your bets. It's not necessarily thinking about what's going to change. It's about thinking what's not going to change, right?
mm, mm.
Things that are not going to change, or pets are still going to need to eat, right?
Yeah,
Nutrition is pretty basic. It's going to happen twice a day.
yeah.
When you change the diet, right, it's a messy situation for everybody involved, and people don't like doing it, right? So it's a pretty sticky use case.
Mm,
And while you may see changes about, around the type of food, the way it's delivered, how fresh it is, what type of form factor it comes in,
mm, mm,
dogs will still eat, right? They will still eat. And so I think those are the types of things which you can hang your hat on and say, we should probably have some of those companies in our portfolio, right?
yeah. Love it. Charles, thank you so much for joining us today.
Of course, yeah. Pleasure to meet you. Thanks again for making time. And yeah, look forward to staying in touch.
Yeah. Your insight in the pet care ecosystem from investing to innovation to, founder mindset. The future trends were incredibly valuable. To our listeners, whether you are early days of building your pet brand or scaling to new heights, I hope today's conversation gave you a fresh ideas, perspective, and inspiration to take a business to the next level. If you enjoyed this episode, make sure to subscribe, leave a review, and share it with your fellow pet entrepreneurs. I'm Varnit, and this is the Pet Brand Podcast, where pet brands comes to grow. Until next time, take care and give your furry friends a little extra love from us.